So you guys have all heard me talking about the money multiplier method, changing one thing, and how to make your money actually move. But nobody has heard me talk more than Shauna here, because she sits right next to me. She hears me talk 8 hours, 10 hours, 12 hours a day. Yeah, so you deposit money into this just like you would your bank account, and exactly. It's what Albert Einstein said was the eighth wonder of the world. That money earns a guaranteed 4%, plus these companies pay dividends every year. Yeah, so you're just gonna treat your money the same way you treat the bank's money. He said compound interest is the most powerful force in the universe. You would pay them back with interest and principal. The same thing, this is your bank. And that's exactly what you're tapping into. So it's the same exact thing. If you took money from the bank, you're tapping into uninterrupted compound interest. It's insane. Every single week. And the funniest thing about this is I didn't even know she started her banking policy. I heard through Hannah that she had begun her first banking policy, and I'm like, wait a second, you started a policy? Like, this was a unique experience for me because she sits next to me and we never really talked about it, but I think she just got sick of hearing me talk about it and finally took action on it. So tell me a little bit about your motive and why you did that.
All right. Well, the first reason why I went to Hannah was because he's just too busy to, I can't get a word in edgewise because he's too busy. But so I just had a couple of questions for Hannah that just shot her a text and just gave her my numbers. But I had learned a lot of the policies start like 10 times your age, and I just decided to start with 15 times my age. So I came up with $480 a month, and I just shot a text to Hannah, and then we got that ball rolling. And then Chris found out eventually. But where I was is I heard, all the different phone calls, all the different scenarios that people are using this method for. And, a lot of it was debt consolidation, or a lot of it was real estate investing. And I didn't really fall into a lot of the categories. So at first I kind of couldn't find where that would work for me. I didn't have debt, I didn't have student loans, my car payment was paid off at the time, and I just kind of am a recovering mattress stuffer, as I say. Like, I just had envelopes of cash at one point,
When Shauna told me what she did, she says, I'm saving money in my mattress. I'm like, you're doing what? You're putting money in a mattress? I thought that was absolutely crazy. But that's because I was a couple steps ahead of her. You see, I've already been doing this, being my own bank. She heard about this and she said, you know what? My mattress isn't the place for my money anymore. How many of you are treating your money the same way Shauna used to? Envelopes, traditional banks that pay you nothing when they go out and make 400 to 1,300% more than you do. Or maybe you actually are putting money under your mattress, and I'm gonna say, are you freaking crazy? Put your money to work for you. Be the bank. Change one thing, folks, just one. Yeah, so the other thing too, I think a lot of people screw up with is they see a lot of our presentations, 10,000, 25,000, 50,000 going in, and I think a lot of people think, oh, well, I don't have that much, so this must not work for me. Or if this is just something the wealthy use, I have to get to that point before this is gonna work. And that's not the case at all. And I love that you took action on it, because you were just like, okay, well, I'm stuffing money in envelopes in my mattress. And you probably saw it and you said, you know what? I'm already doing the quote unquote Dave Ramsey method. I'm using envelopes, stuffing it away for specific goals, whether it be dirt bikes or Disney trips, which I know we're going to talk a lot about Disney. And then you're like, but every time I take the money out of the envelope and I give it to Disney, I give it, to the person for the dirt bike, that money's gone. And you're like, I should be getting something for that. And that's what you, I think, resonated with.
Right. So I never really had like a positive money role model. I kind of had, I knew more so what not to do with your money, but I didn't know what to do with it. Like, I just knew, okay, that didn't work out for my mom, I don't want to do that. That didn't work out for them, I don't want to do that. So, but I didn't really have the opposite, where I was like, okay, this is what I should be doing. And I was definitely stuck in the earn and spend, not like earn and invest, I guess you would say, and then spend from there. So like Chris was saying, I'd have an envelope, I'd get it up to $3,000, I'd go buy a dirt bike, the envelope would sit there empty. I'd fill it back up over time, and then I'd go to Disney with my daughter, and I would just keep doing that. So I was in a way recycling and recapturing my money, but along the way, there's no, I don't know, there's no protection. You know, if my house burned down, there goes, I mean, $3,000, who cares? But I don't know. So I just am going, that's where I'm at.
I think what you said is pretty important because I think there's a lot of people that live with that mentality of, I make money, I spend money. I make money, I spend money. It's exactly why statistics show that out of $1 that somebody makes, 90 cents goes to somebody else. Our whole lives, we've been taught and conditioned to go out and make money and spend money. Make money, spend money, exchange money for goods and services, and that's just what we've done. We've gotten very good at making money and then spending it. That's why statistically people give away 90 cents of every dollar they make. But this strategy right here, privatized banking and the infinite banking concept, gives you the ability to do the same thing. Go out there, make money, and then go out and buy the goods and services, but you change one thing. And that one thing is where the money you make goes first. Instead of taking this money, making it, and putting it in the bank, which a lot of people don't like banks, you take this money, you put it into your bank. Then from your bank, you go buy goods and services. Changing just that one thing with what you do with your money will change everything, just like it will for Shauna. Your money will then continue to work for you for the rest of your life and never change the dynamics of what you're already doing with the money, and that is spending it. Because that's what we're brought up to understand. You make money, you go out and you buy the goods and services that you want. And this is always being transferred and exchanged to somebody else for all of that. And in your method, you were using envelopes, you know, the old Dave Ramsey methodology. And, you know, I agree with it. Like, it works. It's a mental thing. It allows you to compartmentalize your money. But the problem is when you fill an envelope with money and then you take it out and you go and you buy the dirt bike, the envelope is empty and you have absolutely nothing besides the good that you bought, the goods or services you bought. So what if, and I think this is what you saw, instead of an envelope, you put your money into something that paid you uninterrupted compound interest. So that then when you've got the money in this, and if I had a marker, I'd write IBC, infinite banking concept on this, then all of a sudden you take money out, your money never actually leaves the envelope. But you have the money in your hands because the insurance company gives you an advance of that death benefit, which we haven't really talked about. And I know for your little one that was important. But now all the money stays in your envelope, but you had the money in your possession that you bought the dirt bike or you paid for Disney, except for now the envelope continues to keep earning interest. Then the other thing that I think is interesting that a lot of people don't look at is a lot of people use the other envelope, which is the credit card. You know, they love swiping the credit card with the intentions that at the end of the month, they're going to pay the credit card off. But for some reason, the credit card doesn't always seem to get paid off. But in a strategy like this, what you could actually do is you could use the credit card, and I'm alluding to it as another envelope, but you use the credit card to buy your goods and services, and at the end of the month, you have this envelope, which is your banking policy that you can take money from to pay off this credit card. Now all of a sudden you got all the rewards.
Yeah, that's literally what I would do because obviously I can't book a flight with an envelope of cash. So I would swipe a card and then I'd pay it off. I just felt safer putting my money in my control, I would say. You know, just I don't know if it's the baby boomers in my life or whatnot, but I've just always felt like, even before learning about a safer place to put money, I just never wanted to have all my eggs in the traditional bank. And it's not even like anything bad has ever happened to me. I just don't know if people have that feeling. I do. I'd like to have it. I like to see it, feel it, and touch it, I guess, sometimes. But at one point, I actually had the same $5,000 in an envelope for 3 years. I just kept sitting on it, and I didn't necessarily pull from it or need it. And then I realized, like, you know, that $5,000 meant a lot to me 3 years ago, and then like now it's just to depreciation alone, it's just not the same. So I kind of almost like was a little bit mad at myself for like, why didn't I do something with it 3 years ago? But so the thing that also prompted me to start this was just the whole hidden tax of inflation that we are losing 3.2% to every year.
You know, I think one of the most important things to remember is if Shauna had just continued putting her money in those envelopes, leaving it sit, and doing the things she would have been doing normally, the things she was taught to do, her money lost $160 every single year to what is called inflation. And if you took that 160 and you multiplied that times 20 years into the future, that 20 years into the future would be over $3,000 that her money would have lost. Over $3,000. Think about that. Her $5,000 would have lost over $3,000 over a 20-year period of time. That's how much money you lose to inflation every single year, and you don't even think about it. Inflation's a hidden tax that's diminishing your wealth. And all she did is changed one thing, just one thing in her life, and that was where her money went first. And because of that, she paced inflation. She didn't just keep pace with inflation, she beat inflation. After 5 years, 10 years, 15 years, and 20 years, her money was crushing inflation. Check the numbers out. Let me know what you think of Shauna's plan versus your plan. And hey, maybe you like just giving money to the government, but myself and Shauna, we'd rather give money to Mickey Mouse.
So I was, in one hand trying to pat myself on the back for saving money and not spending it, and at the same time losing. I could have invested it. I could have done something with it to at least, even if I just kept pace with inflation, that would have been helpful.
And I think a lot of people do that. They put their money in something, they save that money thinking, oh, it's safe. I won't lose any money this way. And if I go in the stock market, I'll lose money. If I invest in that, I'll lose money. This is safe. It's under my mattress. It's in my envelope. But what they don't realize is that every single day that goes by, your money becomes worth less because of a hidden tax called inflation. And inflation is misunderstood. Inflation, a lot of people think, is goods and services, the milk, the gas, the bread that you buy at the store. They think that the price of that good or service goes up. That's really not what inflation is. Inflation is actually your dollars become worth less. Like you just said, over 3 years, your $5,000 eroded at $480. So she lost $480 just because of inflation, because her dollars become worth less. And that's a big thing right now, Shauna. I mean, the government just printed trillions of dollars of debt, trillions of dollars for the stimulus bailout for COVID. And when they print money, that brings your current dollars down in value, because that money they print has to get its value from somewhere. And guess where it gets its value from? Right here. Your money today is the most valuable money you'll ever have. It will not be worth more in the future like some people think. And to prove that, if you go back 20 years ago with $1, how many candy bars could you have bought?
20 years ago? I don't know.
More than you can today. That's the only right answer. You could have bought more candy bars for $1 20 years ago than you can today. I don't even think you can buy a candy bar for $1.
No.
But so I think one of the other things about what you did is you're now pacing inflation, or at least keeping up with it. If inflation's averaging 3.2 and you're making a guaranteed 4% on your money, that 400, you said 470 or 480 you're putting on?
Ironically, 400 and what I lost to inflation over 3 years that's the same exact number that I'm going. Yeah. So 480 a month was I just went off 15 times my age. I'm 32, and so it was 480 a month, and I think that was like 5,760 for the year, and I had it laying around, and so I just put it all in annually. Like I came up with the monthly figure of what I could afford, I guess you would say, and I just put it in all annually so that it was compounding for the year rather than 480 a month. And I don't know. I figured doing it that way was better.
I'd love to ask, how many of you actually use the envelope method, where you take your money that you earn and you just pop it in an envelope and you save it for that rainy day or that future goal, that Disney trip, and you just leave the money there, and then somehow that money just stays there and it just sits year over year because you don't have somewhere for it to go, and you're thinking, well, it's at least safe there. I bet you there's a lot more people that do that, but wouldn't it be so nice to actually do what Shauna did, where now she's got her money in her envelope called the banking policy that she started, and then when she wants to buy something, she can go in and she can take some of that money out, go buy what she wants, or pay for a Disney trip, or buy dirt bikes, or whatever she wants to do. Buy them, but the money is still in the envelope, in the banking policy, earning interest, keeping pace with inflation, and providing a legacy for you. So let's talk a little bit about, you didn't have any debt. You had no car payments, nothing. So when you did this, what was the big thing you thought about using this for?
So I put in 5760, and I think the cash value. Also, I set it up as like a Legacy 100, so I didn't need like a HECV. I didn't need access to it all up front. So I ended up with like a $3,500-ish
Cash value.
Cash value. Mm-hmm. So a trip to Disney for me and just my daughter is about $2,800. But I think you could do a lot of purchases in a year for $3,500. Like if you needed new appliances, like one year I got new furniture last year for $3,500. And then over time, so over a few years, when my cash value is at maybe like 20,000 or something like that, I plan to, invest it in lending on like a real estate deal or something like that. But just even those small payments, like if you're a $300 a month payment or a $500 a month payment, there's still uses that you can find in a year to make this just a better way to spend. Even if I'm spending it anyways, I'm going to Disney anyways, I'm going to buy a childish item anyways that I find on Craigslist. So I mean, at this rate, at least at the end of the day, I have a death benefit. Before this, I had maybe a term insurance policy for $70,000 that I paid like $19 a month for. Otherwise, that's all that was really left to my daughter. Is like, yeah, I'm spending, I'm going on vacation, I'm buying things, I'm enjoying my life right now as it is, but I'm not really planning for the future. At least this way I have, I guess, more safety, and I'm more reliable while I still get to be childish and do the things that I want to do. So
like buy dirt bikes
Yeah.
and cabriolets and all sorts of fun things. I think you said a couple things that are important there. Is, before you were doing the envelope with the term insurance. You bought term insurance because it was inexpensive at $19 a month. And a lot of people think cheap is better. Mm-hmm. Okay, if I'm going to buy insurance, I want the cheapest insurance. But a lot of times people don't know the whole truth. That's why I always say the Will Rogers quote, the biggest problem in America is not what people don't know, it's what they think they know that just ain't so. But if you're doing the term, I'm not saying there's anything wrong with that. I have lots of term.
I still just held on to even when I did this, I wasn't like, oh, I'm going to call and cancel that $70,000 term insurance policy. It's $19 a month. I'm just going to leave that untouched, and I don't care about that.
So now your money gets to do double duty. Number one, you've provided a legacy, so if anything ever should happen, there's that death benefit that's paid out. But now you actually have your money going into a place that's going to keep pace with inflation, okay, with the guaranteed interest rate that you're earning. Plus now also you can access that money to take trips to Disney. And if I'm not mistaken, and one other thing too you did that you said is, you looked at the minimums that you could put into this to work. So if 10 times age is your minimum, you did 15 times age just because you kind of had a goal. And then instead of putting it in monthly, which, is the way that most people would do it, you said, you know what, I have the money in an envelope. Mm-hmm. Why not put it all in all at once? Why did you do the money all at once as an annual deposit versus doing it every single month?
Well, even though I didn't reach out to him to start the policy, I did say, is there like a perk to just like with your car insurance, like if you pay for the 6 months, there's like a discount usually, and I'm all for some sort of savings, and there was a benefit to just putting it in annually versus monthly or quarterly or semi-annually. So I just did it annually to make it work that much better.
Sure. And one of the things too that a lot of people don't look at is putting your money all in one shot. Your money is all earning interest plus dividends the entire year. Instead of a little bit each month, building and building, all of it went to work at once. Plus the insurance company doesn't charge you that premium load, if you will, on the monthlies, because if you do it monthly, they charge you a little bit. Mm-hmm. So now all of a sudden you got to take back that fee.
Yeah, I don't remember the exact number, but even though 480 times 12 was like 5,760, I actually only ended up putting in like whatever it was. It was actually less than that, but I still reap the benefits of that much. Absolutely. And then I also started a policy for Harper too. She's 8. And I think I did $240 a month for her, and I did quarterly.
One of the things I loved that she said, and I didn't even know this, after she started her policy, she went out and started a policy for her daughter. and then she put some money per month away. Actually, I think she was doing it quarterly, because it doesn't matter how you want to put money into your plan. You can do any which way. You can do it monthly, quarterly, semi-annually, or put it all in upfront like Shauna did. She started a plan for her daughter. What is that plan going to look like for Harper in 5 years, 10 years, 15 years, or 20 years? Will that plan pay for all of her Disney trips for her kids? Will that plan pay for some of her college? Maybe a new car when she needs one? Maybe a down payment on a house? The impact of time and money it's massive. And that's what she's gonna see, and that's the benefit. That's what she caught up on by listening to me chat blah, 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 blah every day for 8 hours a day. And she's finally like, I'm sick of it. I want my own. And she took action. It's time for you to take action. That thing's gonna be a monster when she's older.
I'm hoping that, like when she's 18 or 20 or something like that, like I'll be able to help her use the cash value in a way that's gonna catapult her adult life.
And it certainly will. I mean, even though to you and I, like that 200 seems like a small deposit for her at her age, she's got so much time and so much compounding will happen over that time that thing will grow to probably pretty crazy numbers. She'll have a bunch. All right, so now let's talk about what you're going to use your money for and talk about Disney World with these funny ears that we're wearing.
And just in the beginning, like I said, there was only like $3,500 that I could work with, but that totally covers the trip to Disney and all the things for us. So pretty much just purchase the tickets and all that stuff on a credit card, pay the credit card right off. Before, what I was doing is I would maybe break the credit card payment into a few, like 4 or 5 months payments and pay it all back. So yeah, essentially swiping this.
But didn't you get these using points from your credit card?
Yeah, so I mean, it's a way of like double dipping, I would say, is like use a credit card, get the benefits from there, because there's like all sorts of discounts on food and what are these things called? Souvenirs. But yeah, that way you can do it all. I mean, I think you already know the best way to buy things sometimes is on those credit cards, like if it's a Lowe's credit card or a Disney credit card or even a Southwest credit card, there's always some sort of perk in there for you, and you can still do that and pay for it with this.
So you get these for free using the points from this, but then you use your money in your banking policy to pay this off? Not bad. I like that strategy. I think a lot of people think, that if they don't have debts, like our video shows us paying off and so many of other things, and they don't have large deposits, they think, oh, this isn't going to work for me. But, I mean, how many things can you think of to buy for $3,000 or $4,000 or $5,000?
In my mind, I have so many ideas. I want freaking LASIK eye surgery. Like you could do. I feel like you can find things to spend money on.
Appliances for your house, new furniture, new dirt bikes, mini bikes, four-wheelers, snowboard trips.
Oh, actually, yeah. I'm going to buy our season's passes next year this way too.
Oh, that's a great idea. Yeah, because you get the discount if you buy them early, and you'll have the money sitting there.
Yeah.
Perfect.
So I think it's just a better way. Before I was earning and spending, and this is just a better way. I'm still spending. It's just a better way of doing it.
And I think a lot of people, probably do that kind of stuff. They save money for a specific thing, but the problem is their money is always eroding to inflation. They're not earning anything on that money. Plus, they don't have the benefit of the tax advantages that you have in this plan. They don't have the advantages of the death benefit. If you've got a little one, it's not bad to have additional death benefit. So this just provides so much more than the traditional savings methods of popping your hard-earned dollars into an envelope and then just saying, all right, well, I'm going to keep doing this, and that's going to be used to pay for my Disney trip, my dirt bike, my season passes over to the ski resort. It's just a much better way of saving it. And all she did was listen to me talk 8 hours a day, every day for how many months?
Years.
For a long time. And then she changed just one thing. That's all she changed, is one thing, and put the money into this specially designed and engineered whole life policy. And now all of a sudden she's figured out how to actually become the bank, how not to have to give up the inflationary pressures or, have your money deteriorate to inflation every single year. And now she gets to do all the same things she was doing before. She didn't have to save any more money than she was before, and she's got a lot more going. So we got out all the little props that the points from the credit card paid for, and now we're looking at Shauna's numbers. But you didn't talk anything about who this is all for.
Yes, this is my daughter Harper, and I believe in patterns, and I never got to go on vacation until I was literally old enough to go to work and pay for it myself. So I started to take Harper to Disney when she was 10 months old, which is just so weird. I know people are like, they'll never remember it. She remembers, the one time I sat in chocolate, she'll never let me forget it. That I had white shorts on and sat in chocolate at Disney World, but that's
Whoops.
Besides the point. And, but so we've made it a pattern to go every year, and it's become a non-negotiable, and it was an easy first way to spend the policy money, I guess you'd say.
And we've got all your numbers up here. Donald Duck and Mickey Mouse have been reviewing them to make sure that they are accurate and up to snuff. So the first year you put in, let's see here, you put in $57.60, and then you have $33.62 that you can take out, and that's going to fund your next Disney trip, I believe. But what happens is over time, as you keep putting money into this, like for example, by the 6th year, you're putting money in every year and she's using it. So she's putting money in and then taking it out to go see Mickey Mouse, Donald Duck, and the princesses, as you see here. And obviously, during the process, getting more little ears, like these pretty ones that we have on. I know you guys love this. So you guys get to use your points and you get to use them most effectively to buy these things. But by the 6th year, you put in $57.60, but you actually have more than $57.60 to take out, because now the plan's hit its efficiency point and you're able to take out $57.79. I think this is a unique part in all these plans. Now, we talk about this a lot, but let me explain this. This would be like when you go to Disney World, there's vending machines everywhere, right? Imagine if you went to Disney World and you put well, I think they all take $5 bills there. I don't think there's anything for $1. You put a $5 bill in the vending machine, and the vending machine all of a sudden spits out your $5 bill, and you're like, oh, it's broken. But then you push the button to get Mickey Mouse here, because that's what you're buying for $5. So you push the button, and Mickey Mouse falls. And you're like, oh, this vending machine's definitely broken. I got my $5 back. I got my Mickey Mouse hand toy here. And then all of a sudden, you're just about to walk away, and you hear cha-ching, cha-ching. It drops some change. And you're like, you look around, you're like, anyone else seeing this? You pull out another $5 bill, you put it in the vending machine, it does the same thing. It gives you the $5 back. Then Donald Duck falls out, and you're like, this is freaking cool. And you're just about to walk away, you're like, oh, it's not gonna give me the change. You hear cha-ching, cha-ching, cha-ching. And every single time you put the $5 in, it gets you a new toy, and you hear the change drawer, cha-chink, cha-chink, cha-chink. That's what this plan is. This specially designed and engineered whole life that we set up for you, or you set up for you, I didn't set it up. This plan, every single year after the 6th year, you have more money than what you did before. So Mickey Mouse will point out here that in year 7, you put in $57.60, but you have $63.54. By year 10, you put in $57.60, and you have $69.81. Every single year that goes by for the rest of your life, all the way down, doesn't matter what age you hit, there's going to be more money that you're putting in, or more money that you're getting out for every dollar you put in. And I think we ran this to, what did we do? We did up to year 22. So by the 22nd year, you will have put in $80,640 total, okay? But you will have taken out for your Disney trips, your dirt bikes, your expanded garage, let's see, your snowboard passes and everything else, you took out $121,645. Should anything ever happen to you along the way, you had just shy of a $500,000 death benefit. So something happens, she gets to go to Disney for the rest of her life on this policy. Not too shabby.
Yeah, it's pretty awesome. And even if it's just for life insurance in general, to make sure that she's taken care of is really important to me, so.
I think it's awesome. And this is our mapping team does this. We build this cash flow model, which shows every single year. She knows exactly how much money she has to take out for that trip. So every year, if you'll notice, you have more and more and more and more and more money. So you're going to have to take nicer and nicer trips. Eventually, when you get to that point, you guys are going to be flying first class.
Yeah.
And then not
Maybe we
only
will.
that, I think one other really cool thing about this is your returns. So when people put money somewhere, they always want a return on their money. Now we know that this gets a guaranteed 4%, plus she gets a dividend every year. So what we do is we actually show you your cash on cash returns. So by year 5, you put in 5760. That 5760 net of costs, net of the cost of insurance for the death benefit, net of that annual $50 policy fee, you made 5.28% cash on cash return. But wait, there's more. By the time you do that in the 10th year, because we did every 5 years, by year 10 you put 5760 in and you made 33% on your money. Okay, not too bad. So you put in 5760, but you took out 7,680. And then after that, you were asking, you said, well, how come in year 11 I can only put $2,304 in?
Yeah.
It's the MEC rules. So the IRS has limits that were set. So back a long time ago when the tax code was written, well before Mickey Mouse was in existence, the tax code basically, well, this was actually in 1988, but the tax code made it so that there's a MEC 7 pay rule, and I'm not going to get in the weeds, but that's the most you can put in by IRS standards. They don't let you just keep putting the amount you want in forever and ever. They limit it. So in year 11, we dropped down to 2304. But in year 15, that 2304 gives you the ability to take out $5,898. That's
Yeah,
not too
that's
shabby.
crazy.
It's 155.99% cash on cash return on your money. And by 20 years old, you put in 2304, you can take out 8,123. Imagine going to your bank, or your old way of doing it, the envelope, right? Imagine putting $2,304 in this envelope. Then wait a year, not even, you come back and you open the envelope back up and you're like, it feels a little heavier. And all of a sudden you look at it and there's $8,121 in there.
Crazy.
And you're just like, wait a second, I only put 2304. That's the power of uninterrupted compound interest. And that is a 252% cash on cash return.
That's
So I
awesome.
mean, this silly, specially designed and engineered whole life that you started to fund your Mickey Mouse and Disney trips and maybe buy season passes, that's what it's going to do for you in the future.
Yeah, like I said, I just was coming at it from, I didn't have debt, so I didn't need to get out of it, and I wasn't in a sticky situation, and I didn't have any sort of real estate investments or anything that I was trying to accomplish, but it's just a better way to I was saving and spending, so this is just a better way to do saving and spending.
Awesome. So Mickey Mouse said, no more need for envelopes. High five. Don't leave me hanging. I bet you it's hard for you to take me serious with these ears on, but you know what's hard for me to take serious? When people tell me I don't have any money to do this. Because you're spending your money somewhere, your money's going somewhere every single day of every single week of every single month. You're giving your money away. Why don't you just start by looking at who you're giving your money to and then take that money back? That's all you gotta do. Stop coming up with excuses as to why you can't do something and start thinking about ways you can do it, because you know what? I did this, and I'm actually talking to you seriously, but you're not taking me serious. I'm not taking you serious when you say you can't do something. You can. And so you do. Yeah, something like that. It's really not about, it's about the numbers and about the math, but it's about the concept and how that works. So
Right.
do you want to hit that first? Because you're really good at
Yeah.
explaining this.
Well, I just use my own logics. I do understand why people don't understand it fully, because I really do hear this stuff 5 days a week, week after week, and there's still parts of it that I don't fully understand. And even when I did do my policy and all the things, and when I got the illustration, even working here and knowing what I know or hearing what I hear, I still was looking at it just being like, what the heck does any of this mean? So I do understand why some people get hung up in the numbers. And I pretty much just had to tell myself, like, it works, and just sign on the dotted line and deposit your money. And honestly, that's like what I had to tell myself. And it was a little bit easier for me because I also work on the back end. And like, if it didn't work, I think I would be seeing it not working, and nobody calls and says it doesn't work. I threw together like 2 slides to just show something that I used my policy for a couple weeks ago. I'll share my screen real quick. I'm not making any money out of it. This is me just using it. You normally teach, like what you normally teach every week is then like charging above and beyond that. But if you can already see the values of like just using it for yourself, it might open up some doors, I guess, for what you normally are teaching every week. Everybody, at least I think, makes like a crazy COVID impulse purchase. So then I'm online and I'm looking up go-karts, and I find a go-kart online for $1,500, place the order on my Capital One credit card, and I'm going to pay off this $1,500 credit card with my policy. So I get the order rolling, and then we get this little red go-kart here that Harper's got. So I used the Capital One credit card. I think I got 2533 back for just using the Capital One to the penny, and took a loan from my Mass Mutual, which was at 5%.
Where people seem to get hung up, or they think we're like intentionally holding something back, Shauna, is the 5% interest on the loans.
And I looked up my Capital One credit card yesterday, and it's 22.90%. So even just for me to buy something that I want, I am avoiding paying 17.9% to Capital One, and I'm still able to do it this way. It's almost like giving yourself a discount on stuff that you would use a credit card for. Was my logic. If I paid $260 a month for 6 months, like I'll have paid that back.
It's a great way to look at it. And I love that you made the correlation between, the toy that you bought, because I think you're right. I mean, how many of you listening to this right now during COVID went out and did some type of spontaneous purchase, a brand new car, a go-kart, a dirt bike? I mean, come on, you guys bought something, right? Spent that stimmy money, as Steven would say. Okay. So, some people I'm sure did, but how did you buy it? Who's getting that money every single month? Is it your bank, or is it someone else's? What Shauna just described is, she used her credit card to buy that, because that's kind of how we buy things online. And then you put your work suit on, and you went out there with your tools you just bought, and you put it together.
Yeah.
For those of you that don't know, Shauna's pretty handy. She's got like a whole garage of tools. So she does all of her work herself. And, you used your credit card to do that. Then you looked at the credit card, you're like, holy crap, what was it? 22.9%?
Yeah, it's just a personal thing. I definitely was taught, you don't buy things you can't afford. I feel really bad for people who do get into those situations. I don't know. I just try not to live above my means. But like I said, it's just, in my mind, it's just giving myself a discount on interest. I use them to get, points back, keep my credit going, and then I pay them off at the end of the month. And this was just a way that I could make a purchase that was like an impulse purchase, and maybe like, a little bit out there, but pay 5% instead of paying 22. I don't know if my mentality is right, but
what do you mean? Like, okay, think about that. Do you want to pay 22+% or 5% to, like, which one is it going to be? It's just math. But the thing too, in here, I want to share my screen, because this will, there's some people on here that really like the numbers. So this is your plan and Harper's plan, right?
Yeah.
Okay. So this is the combined between hers and Harper's plan. So there's 2 plans in here. So she started her first plan for herself, and it was a plan built for long-term. And then she started her second branch office for Harper, and that plan is also built. I think that plan's built identical to my daughter Vivi's. So that's also a long-term plan. You put in 8146. And we decided not to use that for Disney, because you didn't end up going to Disney. But then you did that impulse buy, which is right here, the go-kart. You said, you know what? I would have paid. How did you come up with these numbers, the payment that you were going to pay?
I just told Andrew, I was like, I'll probably pay it off in 6 months. I think I was talking to Luco the other day too. He's like a real estate investor, and he usually pays for his own deals. And he's like, sometimes when I do a bunch of deals, like all my money's gone, and then like I just feel poor, like cash poor for a little bit. So could I have paid the $1,500 out of my checking account? Yes. Did I want to feel $1,538 cash poor for a couple months? No. So to make myself just feel a little bit better, I pulled from the policy, and I'm just going to be, six $260 payments. I don't think are really going to make me feel, uncomfortable. So I was talking to Luke about it, and that's like why he just got into Private Money Club, was because he's just like, even though I have the ability to fund all my own deals, I don't want to feel cash poor sometimes. And if there's enough meat on the bone, like I can just use somebody else's money for a little bit. So that's kind of what I was doing. I was like, hold, my checking account totally could have paid off the Capital One, but why not just use the policy?
No, but that makes all the sense in the world. I mean, how many of you that just listened to Shauna say that have that same feeling? I know I do.
Yeah.
We might have 10 grand in our bank account, right? Or under our mattress. But when we want to buy something, we're like, okay, I could spend that money, but then I have, $1,538 less, or I could just put it on the credit card. Or, if it's a car, I could just finance it through the dealership. Then it doesn't feel like you've depleted your capital, and then you're exchanging monthly payments to somebody else. So in an equation like that, this 263 would have went to someone else's bank, right? So how Shauna looked at it, she said, well, okay, if I were to take this 1536, put it on the credit card, I either have to make a $263 payment to Capital One, or I can just make a $263 payment back to myself, which is what you're seeing here in this segregated account.
Yeah. And to be completely honest, like I might not even charge myself anything. I might just pay it back, like just being realistic. I'm only putting in $5,700 a year right now, and I'm only having like $3,000 to work with. Any like real estate deal that anybody's doing right now, they're looking for people who have like 10x to 20x that. You know what I mean? They're not looking for me. So in the meantime, while like before I get to a point where I have like enough money to be doing something to actually like generate money, I'm just using it to also just make myself feel better and not have to feel like my bank account is just getting drained like every month.
And I hear this every week. People get really hung up on that 5% interest that they have to pay back to the insurance company, right? So this is the 5% interest everybody focuses on, because, and I got a cool video that Devin did, we're going to play in a second, to teach you why this is what you're taught to focus on. So you're focused on this, but like, let's just go here to year 5. In year 5, like what Shauna said, she might just pay herself back without paying any interest back to herself, because, depending on what year you're in the policy. Now, remember, I want to be very clear about something. And Shauna, please back me up on this. Your plan is not built like a lot of our clients' plans that are designed for that short-term, easy, fast cash value. Yours is built for the long run. And I mean, you can see how yours is built and how it benefits. But in the short run, your plan isn't designed to really be very efficient in the first 3 years. So you've got a longer runway for building capital in your plan than other people do. So I just want everybody to know that just because this is Shauna's plan, she designed this around her needs and goals. Your plan might look very different. I did a plan this morning. We finalized it for one of my clients. His plan in the second year, I want to be very clear. So in the second year, his plan made $14,000. So he put 80 in and he gets 94 back in the second year. Now, Shauna's wouldn't do that, right? She puts 80 or 57 in and she only gets 35 back that year. You might be like, oh, that would never work for me. Well, that doesn't have to be for you. That's for Shauna. But what I want to do is start getting into why she built this plan. This is the elephant in the room, the gorilla in the room, this 5% loan interest that we got to give back to the insurance company. Why would I ever use my money from my policy when I got to pay the insurance company? These projected cash on cash returns are net, net, net. Okay, we can't show these numbers unless all the costs are out. So the cost for Shauna's life insurance death benefit here, that $200,000 is taken out. The cost for the $50 policy service fee is out. Okay, so all that's out of this. So by the 5th year, she makes 5.28% net. Okay, if she took all of her money out, so if she took $23,000 out to do a private money loan. So let's just say Luke comes to Shauna in 5 years, or actually 4 years now, and says, hey, Shauna, do you want to fund the rehab on one of my flips? And Shauna's like, yeah, absolutely. It's 12% okay. And Luke's like, yeah, 12% is great. She could do that, but it wouldn't even matter if she said, Luke, I really like you. Shauna, don't do this, but I really like you. I'm just going to give you a free loan, because she knows that even if she took all that money out, she's making 5.28, but if she took it all out, she still net made 28. Well, it's not a lot. 28 basis points is how I'm going to say it. So it's not a lot, but she made money, even though she took all of her money out. But see how fast that turns? Look at here, year 6, 1 year later. Let me just clear this. Now that you see what we're doing, now here we go. Let's say Luke comes to her in year 6. She made 10.31%. Okay. If she took all that money out, it's going to have a cost of 5%. So no matter what, even if she took all the money out, she had no money in the account. After she paid the terrible insurance company the interest that they're going to charge, she still makes 5.31%. Now, one last thing, Shauna, and then I want you to comment on this. Yeah. Remember we were talking about that vending machine at Disney World, right? That get Mickey Mouse and Donald Duck, and every time it gave us more change. What I was referring to is this is the more change, okay? 15.56, 21, 27%, 33. These aren't made up numbers, folks. These are right off her illustration. So she here, the vending machine paid her 5.3 net that time. That was the change that was left over. She already got all of her money back. So whatever money she put in, she already took that back. Remember, she puts the $5 in, she got the $5 back. Then she got Donald Duck, and then she got the change. This is the change, the leftover. Okay, here, 33.33% minus 5% that she's got to give back to the insurance company. I mean, I'm not doing the math, but what is that? 20, did I do that right?
33.
Yeah. So that's the change. That's a cha-ching, 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 cha-ching. And look at it, just keeps on going. Her plan is designed to do this. I mean, this gets silly. 155, 191, 252%. I don't care. How many of you would be upset if you had to give back 5% of a 200% return? Nobody. You see, this is what people focus on. They want to focus on, this is what I'm losing. This is, why would I do this? That's what I'm losing. Why would you do this? This is why you would do this.
So in the example of buying the go-kart that I just did a couple weeks ago or whatever, these were my options. I could pay for it cash, and then my bank account's that much lower, and then I probably feel buyer's remorse and I probably feel stupid. Or I could put it on my Capital One credit card and pay it off in 6 months, and then I'm paying 22.90%. Or I could put it on the Capital One credit card and pay it off with the policy loan, and I'm paying 5%. And it just my mentality is whatever at the end of the day makes me feel better, whatever makes me feel better. And this option made me feel better. I don't know if that makes any sense to anybody.
And you don't have to give it up either, because your money's still in the policy compounding for the rest of your life. So even when you buy that, the money doesn't leave your financial family's future. Like, that money's still going to be Harper's in the future. It's in there compounding uninterrupted. So you're paying that 5% to the interest company, but you're really not, because it's in there growing for you. So just
Steve, I'm glad you brought that up. And that's boiled into these numbers. You got to remember, folks, if Shauna puts in 5,700 and takes out 33, she's still being paid on 57. The next year, if she takes out 3544, but yet she never paid back the 3,300, she's now being paid on, what is that, 10, 11,000. I'm going to start losing the math, but you just start adding this up. Whatever amount is in this column, this is what she's earning interest and dividends on, whether or not the money is in the account or not. Now, that is not every whole life policy. Trust me, these are very specially designed to do exactly what you're seeing. And not only that, these are non-direct recognition companies. We actually have a way that we've been pioneering, and I'm really, a couple of my clients are using it, but if everybody hates this 5%, well, I can get money cheaper from the bank. Great. Well, why don't we use the bank? Why don't we go out and get 3.25 to 3.75%? Would you guys rather pay 3.75% or 5%? Well, all of you are probably thinking, well, that's a lower number. I want to pay that. Right. Okay, well, great. We can set up a line of credit collateralized by whatever the cash value is. So whatever her cash value is here, we can collateralize a line of credit using this. Do you know how long the application is from the bank? Can anyone guess? In the chat, I want to know how many of you can guess How, you've all filled loan applications out for banks. Some of them are 5 pages long. Some of them are 3, some of them are 10. How many page long is a application for a cash value line of credit? Can anyone guess? Stephen, what do you think? How long is that application? 1 page, 1 page. It literally asks you next to nothing. Why do you think a bank would be willing to give you a line of credit on your life insurance policy with a 1-page application and they approve it in like a day or 2? Why would that be? Could it be that banks understand this? Could it be that banks know how this works? And could it be that banks are already using this so they realize how secure this is? This is the greatest collateral security that a bank can ever get. So therefore, they will give you money at 325 to 375. They'll give you a debit card. They'll give you checks. They want you to use that line of credit and pay them 375 because they have the greatest security collateralizing that line of credit being the cash value in that column right there. So if you don't like the 5% because you think that's too much, great. There's your alternative. We don't get paid for doing that, but we are going to start teaching it. It's an added step. It does, your credit score does matter. So I think you got to have a 650. We're going to have him on a wealth webinar talking about this, but you get the drift. So there are alternatives, but I don't want to go too deep into that. But that's where people get hung up. Does everybody see that? And I know we've got a lot of questions. So we're gonna get to the questions. Shauna, is there anything else you wanted to add to kind of that whole concept of what we just talked about, that people's focus goes to the one thing that really is, like Stephen said, it doesn't really matter. You already made the money. Yes, you got to give some of it back, a percentage of it back, 5%. But if you made, what is it, 252%, you had to give 5 back. Would anyone care? No.
No. And even, like I said, even the alternative was drain my bank account a little bit or pay a credit card like I've done for years, or basically give myself a discount and drop down that credit card interest rate to 5. I have one more thing to add, just because seriously, my mentality is just like, I just need to sleep better at night. Like that's really like all that I'm after every day. And so like my next payment, I'm paying annually, and I could feel 2 ways right now. So my next annual payment is like September 2nd, and it's like $5,700 or something like that. I did just have my RV towed somewhere, and it's probably going to need several $1,000s of work that's going to be done. But instead of looking at my life right now, like I have a $5,700 life insurance bill coming up in 6 weeks from now or whatever, and now I have car trouble that's probably going to be freaking thousands of dollars. Rather than looking at them as 2 separate things that are going to make me not sleep at night, I'm really kind of just focusing on the $5,700 that's going to go into September, knowing that there's still some cash value left over already when I'm paying back from the go-kart. And then that $5,700 could solve this new problem that I have with the several thousands of dollars of work that's going to need to be done on my RV. But it's helping me and not hurting me. And it is truly helping me sleep better at night. And then like, again, at the end of it, if anything ever happens to me, there's something for Harper besides a whole bunch of broken down things in the yard here.
Yeah, you got a death benefit right there.
Right.
Available. And also, I'm just doing this for visuals, folks. But the other thing too that we got to understand, let's say, in Shauna's 5760, let's say her RV broke down and she didn't have any cash value. I don't know, for some reason she had no money, and she's like, oh my God, I have to decide, do I fix my car or do I make my premium deposit of 57? We build these plans with flexibility. If she ever needed to, she could drop her 5760 down to 2300, and then she could then come back and put the difference in when she got it back after her RV was fixed. So it's not an and or, it's either way. They're built for flexibility because we know that people's lives change. We know that things come up. And if they do come up, you just don't want to be capped because, oh, you got this premium deposit in this private bank you set up. And why did I do that again? Because your mind wants to always drift back to the old way, which is why we're always trying to get you around the campfire more.
I mean, I was gonna say, like, when I was a kid, I was addicted to opium, right? And no, not the drug, guys. OPM, other people's money. Okay,
I was like, wow, I didn't know this about you, Steven.
I was like the same thing.
You said
what
open.
it's what really got me into real estate investing, because I was just like, the idea of leverage and being able to use other people's money to grow your wealth and go out there and make investments. It was just really addicting. Like, it was really cool, and I was like, wow. And then, as I started doing that more and more, then you start looking at the financials. You really start digging in. Like, okay, I am paying somebody else a lot of money to use their money. So what I love about infinite banking is I can create this bank for myself. But like Shauna was saying, it almost doesn't feel like your money. It's your money 100%, right? It's your bank. This is your pride, but it doesn't really feel like your money, because when you take the money out to use it, it doesn't actually go anywhere. So it's like you're still using other people's money, but you're keeping all of that interest in things you were paying to them within your own financial world. So I don't know. That's like the best comparison I've been able to think of when it comes to this.
Oh, it's perfect. And you said you did that when you were a kid, right? So Devin, one of the gentlemen, Devin Burr, many of you know him. He's on our team. Made a video. I got to play this. Number one, you guys are going to laugh your butts off, but it actually has a very significant meaning.
Hey Dad, how do I become successful and wealthy? So first off, you're gonna go to school and get yourself into a lot of debt. This debt will be unforgivable even through bankruptcy. Then you're gonna get a job making about $65,000 a year, if you're lucky. So get myself into a lot of debt and not make a lot of money, okay? Son, why do you keep holding a remote control up to your mouth like it's a microphone? I don't know, I saw someone on TikTok do it, so I thought it was cool. Well, it's not. So next you're gonna max out your 401k and you're gonna actually give up control of your money to other people. What the hell? So like I was saying, you're gonna give up control of your money to someone else. You'll have access to it when you're old and gray, and you're gonna hope and pray that the market doesn't tank and you have enough money to retire. All right, Dad, so what do I do about taxes? So you're gonna work real hard at work to get promoted. You're gonna make more money and you'll get taxed more because of bracket creep. Then, when you retire with your 401k, all the capital gains that it made will be actually taxed as earned income, which is the higher taxes. Dad, isn't this what you did? Exactly. But Dad, aren't you broke? Yeah. Hey, where'd you get all that cash that you're now weirdly using as a microphone? I followed this really dope dude on TikTok, Instagram, and YouTube. All right, cool. I'm gonna follow him as well. God dang it.
Oh my God. That's fantastic.
It was so funny.
First question for you is Theodore, and we'll just kind of hit these groups. So I have another variation of this. I'd like to know, for everyday items, is it better to put all income into a policy and then pull it out to pay for everyday needs, groceries, rents, bills, or just spend cash on needs and only use the policy for items you normally finance or put on credit card? This is a great question. Thank you, Theodore. Steven, do you want to hit that, or Shauna?
My take is I would probably get the method down and get the feel for it on maybe things that you would normally finance, because that's just going to make the most sense. And then if you're confident that you're going to pay, like, throw your rent, your groceries, your all that stuff on a credit card and then pay it off with your policy, I would you just have to hold yourself accountable to actually doing that. So that's also like a personal type of question. Because, like, for me, yes, I am the person who puts stuff on the credit card and pays it off in full at the end of the month. So whether I'm doing that with my bank or my policy, but then I would be paying the policy as well. So it's I don't know.
I think
right?
that's a good way to answer it. And the way I always answer it, and I did a YouTube video, so if you really want to watch the whole thing about this, I don't suggest people in the beginning, in the first few years of their policy, to use the policy to pay their bills. And chances are you wouldn't be able to put all your income through the policy, because the insurance companies usually have a limit on how much of your actual income you can put through. So it wouldn't be all of it. There are ways to get more in, but you have to layer through different policies to do that. But like, think of Shauna's, like, after year 5, she was in her efficiency point, right? She was, if she borrowed the money at 5 and she was making 5.38, I think it was, she's making money. So at that point, it actually would kind of be like her using a credit card with rewards. If she used her money from her policy to pay her normal bills, she's like getting rewards, which is that extra arbitrage. That, and just so everybody knows what arbitrage is, it's the difference between the amount you earn and the amount you pay, or the cost. The split in the middle, the spread, is that arbitrage. And you can see, like in year 6, she was at over 10%. So her arbitrage now climbed to over 5%. How many of you would like to get paid 5% for buying your groceries? Simple way to put that. So Theodore, I wouldn't do it in the early years, but in the later years, depending on the policy's design, Shauna's was year 5. The other gentleman I was talking about is year 2. So once you're there, I mean, you're getting paid for paying your mortgage, your groceries, your rent, your bills. So then it makes sense. But again, it's just not something that we actively teach, because we want to treat our money the same as we treat the bank's money, which means we normally want to use these for things that we would finance or use a loan or a credit card or something else for. But that's a great question, and it's very appropriate. All right, let's see. Ethan said, what is the guaranteed versus non-guaranteed portion of the chart mean? That's great. Is that taking the dividend into account? I can hit this one. It's easy. Ethan, so the guaranteed versus non-guaranteed has only one difference. There's a column that says dividends. Non-guaranteed includes the dividend. Guaranteed includes no dividend. So when you're looking at these illustrations and you look at guaranteed and non-guaranteed, the most accurate one to look at is non-guaranteed, because every insurance company that we build these plans with has paid dividends well over 100 years consecutively without ever missing them. Not only that, right now, I think it's like a 35 or even 40-year low. We are at the lowest dividend rate in almost 40 years for all these companies. So definitely that's the only difference, dividend versus no dividend. Let's see. What about using a HELOC to jumpstart your policy? Stephen, this would be a good one for you. Take that to earn uninterrupted compound interest and pay back the HELOC. Wasn't there someone commenting that they just did this?
Adding the one step of first putting it through the policy, then pulling out to use it for what you're going to use it for anyway. So, money's cheap right now. There's a lot of equity in homes. Get that money out, get that money to work, and why not?
Absolutely. We have tons of people taking money from home equity lines of credit, front loading the plan, dumping it in. If I did that, if I took money from my HELOC, dumped it into my policy, I then would take a loan from the policy, and I would probably use that money to go make more. I might lend it to Chris Root or put it in Safari Fund where it's going to make 12%. Then I would use the 12% interest, which is kind of money out of thin air, is money created by moving my money. I would take that interest and I would pay that back toward the home equity line of credit. Anonymous had a good question here. Does this always make sense given today's low interest rates? For example, your money in the policy makes 6, interest plus dividend, and that's not every policy. That's the one that Shauna was talking about. Okay, but for a car purchase, for example, you can get a 60-month loan at 1.49%. How does that make sense to pay 5% on the money from your policy? You are not paying yourself the 5%. Is that going to the insurance company? Blah, blah, blah. So let me refer back to this, Shauna, and I think this is the absolute easiest way to explain this. If we just go purely off the number, because we get this a lot, why would I use the policy to pay for a car when I can borrow money from the car manufacturer or from the finance company at a cheaper rate?
So if you take a $50,000 car loan at 1.5% over 6 years, let's say, you're still paying, I don't know, about $2,400 to the insurance company or to the finance company in interest. So that's $2,400 that's now gone. On top of that, the $50,000 that you've paid, monthly payments on, is now gone from your life completely. Now, if we had the money in the policy and we take it from the policy, yes, you're paying the 5% annual to the insurance company. A, it's simple interest, but B, your 50,000 is still in the policy compounding. So if you look at her chart, for instance, we start at year 7, right? She gets a 5% return that year. Then the next year, a 9% return. Then the next year, a 15% return on her money. And that's compounding each year. So what we're doing is we're not taking into account that the money never actually leaves the policy. So even though you're paying a 5%, it's in the policy compounding at a rate greater. And on top of that, even that $2,400 you were going to give to the finance company, that now stays within your financial world forever. So $5,300 almost that's gone versus $5,300 that's now back in your policy that's going to continue compounding for you for the rest of your life.
It's why you're on the hamster wheel. Doing it that way is just the earning and spending and earning and spending.
Yeah, I mean, the thing that you're not understanding, Anonymous, is a simple thing called compound interest. What Albert Einstein talked about. It's the most powerful thing. And it's the one thing that everybody thinks they know that they don't know. But here it is at work. Use Shauna's numbers, year 7. So you're in year 7 in the policy, right? You want to buy a new car and you go to Toyota Finance. Forget about your 1.49. Let's just say Toyota was going to give you the money for free. They were going to give you the car in exchange for 0% interest. So it's a zero-sum game. You're just like, oh, well, there's no way I'm going to use my own bank to do this. But okay, now what you're going to do is you're going to give away $2,400 a year, whatever your car payment is. You know, he did $200 a month for the car payment. That money goes to Toyota every single month and it's gone forever. And what do you have in exchange for it? Oh, I didn't have any interest on that money. No, you have a depreciating car that will never be worth what you paid for it, which is the 50 grand or whatever. But here, 15% is her cash on cash return. That's how much she made net. Take 5 from that. So unanimous, what is 15.56 minus 5? It's 10.56%, right? Your bank will pay you to buy the car. Maybe not in the first couple of years, okay? It's inefficient in the 3 years. So you wouldn't want to do that here. So if it was right now for Shauna, she'd be better doing the 1.49. But anywhere after that, she's going to be better off using her bank. And then she gets to keep this $200. And then all that $200 after the term of the loan gives her back the full $50,000 that she paid for the car, plus interest, plus then she still got the car in the driveway. So I don't know a better way to explain that, but unanimous, one thing I would suggest doing is watch the video that shows how to get all the money back for all the cars you've ever bought, driven, and owned. And if you're on this webinar, chances are you probably got that video or the book that I just did, the booklet teaching you that. So heavily, does that make sense, everybody? I just want to make sure I'm not talking in circles. Does that make sense?
Mine's built for the long term because I don't have any sort of retirement plan besides hopefully someday I get something from Social Security. Like otherwise I've always really worked for small business entrepreneur type people who there's just really no retirement kind of plan when it comes to that. So I was like, I have to do something. So if this is how I can sort of put money away for the future at the same time, like using it to pay for things on my credit card, like today, last week, and all that stuff, like that's me still being able to live the life that I'm living, but also being able to prepare for the future. So the 5% to me really doesn't matter because of everything else, the value of everything else. And I don't know if that makes sense to everybody else.
It makes perfect sense. And, for anyone that's caught up in the 5% interest and all that, I mean, we just showed you a way to get the interest under 5%. But, really the thing you also have to understand is the number one thing we're all taught to do with money that is completely keeping us on that hamster wheel is simple. You're giving up control. They trick you, 0% interest rate. Oh, we'll give you this teaser rate of 0% on this credit card. Well, what happens after the 6 or 12 months when that teaser rate ends? It jumps to 29.99. And how many of you can honestly, in your heart of hearts, tell me that every time you got one of those 0% credit cards, you paid it off in exactly enough time where you got to use it for 0? That cash flow that could very much change your family's life, you're giving it away because they've tricked you that this 0% teaser rate is all that matters. It's control of your money that matters, folks. And not only control, we just showed you a way where you can get control plus make interest and dividends in an uninterrupted compound environment to do this. I look at it like flying airplanes. Brent and Nelson Nash talk about this all the time. If you fly an airplane into a headwind, you can't go very fast because whatever the headwind is, subtract that from the max speed of your plane. Like you can't go any faster. You're fighting a headwind. But if you flew it with a tailwind, all of you have, when you're flying across the country, you get one of those planes. Hey, we're way ahead of schedule. We're going to land 15, 20, 30 minutes early because we had a nice tailwind. That plane didn't have to work any harder. Matter of fact, they probably peeled the throttle back, saved on fuel, and the plane still went faster because they flew the plane in an environment that was conducive to the plane flying at a faster speed. Your money can operate in the right environment, but you choose to not operate your money in the right environment. You choose to operate in an environment where everybody else is winning because you're giving up control to them. And all you need to do is change one thing, like we say, and put your money in the right environment with a perpetual tailwind. That's what we're doing. We can get as complicated or as simple, but literally, you want your money to have a perpetual tailwind on it always and forever until the day you die. And the day you die, you want that money to pass on to your family, don't you? Absolutely. But in return for passing money on to your family, do you want to give up control your whole life and say, oh, this money's for little Joey? No, you want to use that money every day, every week, as much as you can. Sorry, I get so passionate about this. Lindsay said, so when you're paying yourself back, is it paying the loan back or just putting money into your account? Typically, when you're paying yourself back, you can do one or the other. You can take the recaptured money, let's use that $200 car payment, and you can just put it into your segregated account. And then you can redeploy it from there. Or you can do what I do, take the 200, move it into the segregated account, then set up an automatic draw to pay the loan back, so that now when I pay the loan back, my policy, I'm paying less interest to the insurance company because the balance drops. So I got a declining balance. Plus that money becomes immediately available for me to use again and again and again. So that's how I do that. Michael said something here. He said, can you address the IRS rule and limits contributions after a certain amount of time? So just like Shauna's, Ben mentioned how you can open many more policies, but does the rule still limit the contributions to those policies? Does it reset each policy year? Nelson Nash mentioned he had 26 or 27 policies at one point. Yes, Michael, I have 7 policies. Brent has 19. Nelson, I think, had 27. Shauna has 2, and everybody on our team has multiple policies. So why do we set up multiple policies? Well, take Shauna's. Okay, we're just going to pick on that because it's fresh. Shauna's premium that we designed that plan at is $57.60. The MEC rule is a MEC 7 pay. It's kind of a limit that the IRS puts. It says based on the death benefit, hers was $258. Based on a $258,000 death benefit, the max Shauna can put in is probably $5,800. So we build the plan slightly under the MEC rule because this is the most efficient way to do it. And then that gives her the ability to fund at $57.60. Shauna couldn't come in and say, hey, I got extra money. Chris just gave me a nice bonus. I want to put $6,500 in. Doesn't work that way. So what Shauna did is she said, okay, I got this plan, but I have extra money. So I want to put it into another plan. Instead of doing another plan on herself, she did a plan on her daughter, Harper. So then she just redirected it. So her plan will never change. The MEC rule is the $57.60 or whatever it is. Harper's plan is built at the MEC limit. Every plan we build is built to that limit. So that's why when we want to put more money in, we layer policies. We just set up more and more policies to hold more and more capital. It's not because we want more policies. It's because we have to play within the rules of the IRS, because if we don't, the consequences are serious. If you don't play by the rules and you MEC your policy, all of your money will be treated like investment money and it will be taxed. It will lose its tax favored benefit of being a life insurance policy. So you don't want to do that. Hopefully that answers that question. Holy crap, Shauna, you got a lot of questions. Anonymous, what is a good minimum to start this concept for someone who is trying to test the waters in the concept? 10 times your age. If you're over 30, or if you're between 30 and 60, take your age. I'm 43. Multiply it times 10, that's 430. That's your minimum monthly amount to start this. If you're under 30, it's 15 times your age. And if you're over 60, it's 15 times your age. That's how you start. And you know, God, we know so many people that have dipped their toe. Devin dipped his toe. Devin's put in hundreds of thousands through his policies now. And he started with a small little tester policy for $6,000. And as soon as he started it, and he took the money from it, he's like, holy crap, it works just like they said. I thought they were full of crap. I thought this was too good to be true. Not the case.
I think I did the same thing. I saw my cash value because I put it in, and because of the compounding interest, I would check it periodically and it would grow. And I remember telling you the one time, I'm like, oh, my cash value is bigger now. And you were like, I know.
People sometimes say things to me and I'm like, isn't this what I say every single day? And they're like, oh yeah, but it actually worked. I'm like, okay, yeah, it worked. Big work to do. We have, I think, like 3,500 clients, and not one person ever has said, oh, this didn't work like Chris and Brent said, or like Chris, Devin. Now the team's so big, it's not just me and Brent anymore. Oh gosh, so funny. Let's see. Anonymous said, if I got denied for a plan, can I take a plan out on my child, or do I need approval before getting one on my child? That's a great question. It happens all the time. If you get denied, we already now know we can't get you coverage. So then yes, you could get coverage on your child. Now, what you can't do is go and say, all right, I'm going to take a policy out on my little Johnny, but I'm not going to get a policy on myself. The insurance company will never allow that. Ethically, it's just, I don't know why you would ever do that. It just doesn't sound right. But yeah, so that's how you do it. But if you get denied, you definitely can. Let's see. Anonymous, how are you able to get more policies when the insurance company says you are sufficiently insured? Ooh, yeah, the human life value. So Anonymous, that's an interesting question, and it's not an easy one to solve. So if you're at your human life value, we have to look at your current death benefit coverage and where all that money is and say, okay, is all of this performing and doing what you want? We might actually have to convert or replace like a term policy with an IBC or a private banking policy to make up that difference. Because if you're your human life value, you're really not going to be able to get any more insurance. You might have to borrow another body, get a child, a spouse or something, or a business partner to do that. That's tricky. Very few people hit the human life values. So if you did, congratulations, you're doing something right, or you're doing something very wrong. So this was Shauna's case study. What did you all think? Wasn't that freaking awesome how she uses it? At first she didn't think this would work for her because she had no debt. How many of you have looked at this and said, I don't have any debt. I don't need a new car. I don't have a need for anything like that. This just must not work for me. And then she kept listening to me and she's like, wait a second. So this doesn't just work for paying off debt. How many of you are in that same boat?
I just want to say one more thing too, is it's sometimes when you start something, it doesn't have to be, it could be anything, right? It could be waking up at 5 a.m. The first time. It could be starting a workout. It could be knowing that if you stop drinking pop, today, that you'll see the effects later on. It doesn't feel like it in the very beginning when you start something, but that compounding interest really does add up at the end, whether you cut out pop for a year and then you're down 12 pounds at the end of the year. It doesn't feel like it when you take that first day and when you do that first thing, but it will unfold for you.
Absolutely. And we're always terrible at doing this. A lot of people are like, oh my gosh, who do I talk to about setting one of these banking policies up? Who do I call? Do I call my local agent? Do I call my broke ass brother-in-law? No, get a hold of us, because this is all we do. We know how to build these, we know how to structure them. And also we have the mapping team, and we are the only ones in this country. Mark my word, the only ones in this country that has a mapping team that you don't have to pay a penny more for. So Steven's going to put up on there, or Shauna, how you can set up an appointment with us. The only thing we ask, and this is a prerequisite, there is a 90-minute video or a 10-part video series for those of you that can't sit still for 90 minutes. You have to watch that before booking a call. It's mandatory. If we get you on the phone and you didn't watch the 90 minutes, we will kindly ask that you watch it and reschedule with us. But if anyone's interested in setting up their first policy, their second, their 20th, we are happy to help. So we'll put that link up right there. It's such an honor to have you on this. I mean, you're always kind of listening and doing all the stuff in the back end. It's just awesome that you came on and shared your story, your wealth of knowledge, and just everything that you've got with everybody here on the Wealth Webinar Series and unpacking it all. Thanks, everybody. We'll see you then.